Privileged today, Hugh and Henry. They've taken on some pretty critical roles in the last year, bit over a year, I think can give us some great insights into not just the toll road sector, but managing large successful companies and navigating a lot of volatility that we've seen not just in markets but in the broader economy as well. So I'm going to start there, and given the very significant roles that you've taken on, give us a view on what's been the most challenging aspect of that. So we'll start with Henry and the CFO role.
Yeah, sure. Well, I mean, beyond the kind of obvious observation that moving from, I've been on Transurban's executive committee for 7 years, running functional lines or markets, but there is undoubtedly another dimension of complexity that comes to taking a full kind of enterprise role, and so working with Michelle at that level has had an additional degree of complexity. But the real observation is probably then the kind of market environment that I've stepped into as we've done that, and I think Michelle would reflect this as well, because we've taken the leadership at a time when the company's probably navigating some of the most significant shifts in its external environment that we have done in many years. I mean, I was going to say in my time at Transurban, but I lived through the GFC and I've lived through some other things there. But what I mean by that is very capital intensive business that's had a very successful strategy it's been able to repeat execute on now for many years. But the current market environment requires some very clear adjustments to that. Money is no longer free. Mm-hmm. We know that. So, how we think about sources of capital, how we think about the existing portfolio, being a little bit more dynamic in our views on that rather than just originate opportunity to grow portfolio, go to external markets and fund, bring it back, set, go, repeat. That's not a play that we think is as readily available in this kind of environment. So precipitates some quite interesting and quite complex discussions around how we think about that, the portfolio kind of theory around that. And then the other piece is obviously just the ever increasing complexity around regulated businesses in this kind of populist environment. So I would say that, in the past 12 to 24 months, that thematic has only increased. It hasn't diminished. And so thinking about how we're actively navigating and positioning the business, and for those of you who know us well, that we talk a lot about the battleground for that being one of perceived and actual value, customer value. Being able to demonstrate that and have that value recognised is really the critical battleground for businesses like ours now if we're to be successful and to navigate that kind of issue.
Great. That was a great answer, Henry. Stole many of my points. Thanks, Peter, and thanks for having us today, everyone. Probably for me, it's my first CEO role in a brand new company. That's a really big challenge. It's a challenge from a stakeholder management perspective, a complexity perspective, a loneliness perspective at the new level. But if I take it back to the company rather than just purely me, I think where we're at is we had a very long-serving CEO who's managed the company from being internalising the management from Macquarie right through a growth phase. But one of the challenges is actually boiling down our focus areas to the key issues. And we have some very clear things out there with a couple of our assets. We have our major investment expiring concession in 10 years. We have a regulatory challenge in Virginia, in Dallas. And we have an asset that was bought 3 years ago that wasn't the most popular deal that was ever done. And so actually facing into those, engaging with the market in a different way, demanding more from my tech, given the geographical diversity is a really big part of that, but actually getting the focus on the things that matter to our investors has been a real push over the first 3 to 4 months. The great news is really good partnership with the board up front, and everything they told me through the interview process was true, which I haven't always found to be the case with interview processes. So an enormous amount to do, but from my perspective, part of it has been trying to simplify the story and understanding what really matters and delivering against that. And that'll be an ongoing journey. It's only been 3 months, so lots of work to do.
I'll stay with you. What are perhaps the 3 things that are consuming your time at the moment and you think you need to deliver on for your shareholders, just as an overview?
Yeah, so the first one we've started to address directly, and that was the distribution and cash flow. We're conscious that the market, particularly as it relates to Atlas Arteria, loves yield. We had committed prior to my leadership of 40 cents per share distribution, and that we would continue to pay that despite changes to French tax, changes to Virginian regulation, and other significant impacts, including the higher interest rates. I spent close to all my first 3 months assessing that, working out whether that was sustainable and working out what to say to the market at our February results. And good news is we got there. It is sustainable, and we have given further guidance beyond the current 1 year horizon, but it was a really big, hard piece of work that was very important. And when I engaged with everyone, including you, in my first couple of weeks in the company, that was the question: what is going to happen with cash flow? The next two issues I flagged already, but really we've been in Dulles Greenway for close to 20 years. We own 100% of the asset. It's never distributed us $1, and we're still in lockup.
Yep.
And that is unsustainable. We have played quite nicely, and we have continued to submit rate cases, but our last increase in tolls was in 2019. And so we have taken a very challenging step, and a very difficult step to make as a new CEO, of suing our regulator. And we've sued them in both the Federal Court and the Supreme Court of Virginia. What has been really informative and a great piece of stakeholder management by the local team is we do continue to work with them in collaboration through our rate case working group. So we're taking aggressive end action and collaborative end action to try and get an outcome there. So from my perspective as new CEO, that's number one priority, to get cash, or to get a path to cash out of Dulles Greenway. And then the third thing I would say is really doubling down on our partnerships. Eiffage partnership has been surprising on the upside for me. Vincent and the local team have an incredibly strong partnership and influence in that asset, despite being a 30% shareholder. As you know, it's our biggest asset by a long margin. But those two main concessions, and a reminder there's 5 concessions in there, but the two main ones expire in 2035 and 36. We need a path beyond that. So we are starting to get really focused on working out significant long-term presence in France. That's got to have Eiffage as part of the solution, but we will also be engaging with the government, the regulator, and the whole sector as to what the new concession arrangements may look like, and that's likely to start in earnest beyond the 2027 presidential elections. So partnerships there and partnerships throughout the portfolio are a really big and increasing focus, and something I think we can learn a lot from Transurban.
Yeah. Henry?
Well, we also have 3 priorities, as Chance would have it as well. So you've seen us talk about a strategy that now is effectively anchored around stakeholders. These are fairly simplistic terms that have quite a bit of detail sitting underneath them, and by stakeholders we mean, clear priorities around resolving the issue here in New South Wales toll reform, and getting to an effective solution with government. And you would have heard us take a fairly optimistic tone on the recent earnings call on that, which reflects where we think that's currently positioned. We're also very focused on how we continue to hone the customer value proposition within the business as a component of that, and then a broader pathway to growth within the business. So we would call that a kind of stakeholder issue, and there are a number of dimensions around that, including some new things like the customer rewards work we've been doing to try and unlock some new value for the business as well. The sort of middle pillar we describe as growth, because we do think we still have a very viable and healthy growth path in front of this business, and I say that knowing that there are questions in the market around what our growth outlook looks like. We have the traditional growth that everyone's familiar with around augmentation of the existing networks, and there are a number of significant projects that we're currently working on to replenish the pipeline that we've got within the business, and Queensland and Virginia are sort of the 2 focal points, but there are opportunities that sit out beyond those 2 markets, and that could be $4 or $5 billion worth of capex easily just in the few projects I have in my mind when I say that. And then we've started to frame up a different discussion which is somewhat tied into that around what we're describing as concession of the future. So what do we need to do to adjust around the margins of these concessions to continue to make them attractive for governments to work with us, for customers to accept the business model? And then there's a range of things that again tie into some of the things I've already mentioned around sort of augmentation of the customer offering that may sit in there, or things we can do in terms of the intelligent infrastructure that we're offering as a component of that as well. So that's the sort of growth pillar. And then the final piece is around efficiency. And so I think everyone's aware we're pretty focused on this. It's probably the thing that shows through most readily, and so anyone who was looking at our numbers would have seen that we're getting that kind of operating leverage that you want to see from a business like ours. Top line growth augmented by cost control, leading to better EBITDA and free cash growth. And that's a feature of the business that we think we can deliver on a multi-year horizon. We've obviously given cost guidance out for the current year. And then we're also thinking about how we might be able to sort of marginally augment the revenue line through improved outcomes around leakage, which are more significant than you might think for a business like ours.
Thanks. Let's dig a bit deeper. I think the elephant in the room last year was the political situation, New South Wales tolling review for you, and French concession taxes.
It was actually New South Wales toll review.
Well, that's true. Yeah, you tell me both.
Yeah.
So
you might answer this one.
let's go a little bit deeper on that. What do you think the core issues of those two situations were, and what does a good outcome look like in the coming 6, 12, 18 months, however long it takes to resolve?
You want me to go?
Yep.
Look, I think we can all trace the genesis of these kinds of actions by governments to an environment we've all found ourselves in around cost of living. It's a global narrative. When we travel offshore, we encounter it everywhere we go, and Australia is not exempt from that. In fact, if anything, I would say you see more extreme manifestations of it offshore than you do here potentially, and that might be something you might talk about when you get to France. But for us, clearly that was the genesis behind why the current New South Wales government made that an election issue and then brought it forward and sort of ran that process that they've run. The good news is, and something I often say to investors is, the political risk profile is actually manifesting in a way that suggests we all read it right. So they're engaged, they've made very clear representations that they understand contracts need to be protected, we need to be kept whole on value, and indeed they've gone as far as to acknowledge that the timing of revenues is important in the mix as we work through a solution, such that the investment profile of the business and the distribution profile isn't disrupted as a result of the outcomes that we're trying to get to them. So you say that's a good position to be in when you then overlay that with the fact that we're in a very familiar bilateral discussion with bureaucratic counterparties under a process that has been articulated by government to manage the probity. So again, familiar. And then the final piece, and the piece that probably gave us reason to be optimistic in our tone on the earnings call, was that we're talking about tangible solutions that could help them meet their objectives and us meet ours. We obviously can't talk about the detail because we're tied up every which way in confidentiality agreements with them, and but the reality is that we can see a path here. So you add all that up and it says that we have reason to be optimistic here, I think.
So a bit of give and take, NPV neutral by when? And
I've met most of you actually in one-on-ones, and I don't think I've answered that question for anyone. So we have conspicuously resisted putting a time frame on it because we are dealing with governments, and governments can be difficult in terms of pinning down on that. But the one thing I would say is everyone understands the urgency, including the government, and if anything, for anyone who reads the media, you would see that the government is under some pressure to resolve this. So I think that says that the time criticality of it is well understood by all.
Yeah, we'll go with June 30.
French tax?
Yeah.
Slightly different issue to what Henry described. So ours is more budgetary driven. Instability in the French Parliament has seen 2 new taxes that influence us implemented in the last 18 months. We've had the TILD, which is the long distance transport tax, hits airports and toll roads. And we've had the temporary supplemental tax, which is a 1-year additional tax for large companies in France. And look, the combination of those is hundreds of millions of dollars. One is very much a 1-year, the TST. The TILD is the one that's the real problem for us, which is a permanent feature now of the tax structure in France. We've taken a constitutional challenge which will probably not succeed. So we've been very open to say that the next step is contractual, and that would split. Currently the constitutional challenge is all the businesses affected together. We would then split into contract by contract. Good news is the government, much like Henry described in the New South Wales government, historically has engaged on these things, and twice before we've achieved concession adjusted settlements in relation to additional taxes that have affected the toll road sector. The timing and the ability to do that is really complicated, so I'm not going to say June 30 like Henry did. I'm going to say it's going to take years if we go down the litigation path.
Yeah.
If it's a negotiated path, I don't see it even commencing before we have stability in the parliament. And the other challenge we face is a little bit different to Transurban. We have 10 years left of those concessions, so there is less flexibility in being able to create enough value to address that offset, or to offset that impact. So we're being really open. We are approaching it the same way. We are importantly allowing it to be led by Eiffage, because we actually think it's very important to be a local discussion and led by local partners who understand the local politicians, but we're at that table and supporting them.
Yeah. And not just Eiffage, I guess all the French motorways as a
group. So Sentier Investors all got the same issues as do the airports. And literally almost, I think, all bar one of impacted companies was in the constitutional challenge. So I assume each of those will then progress to contractual challenges.
Right.
Yes.
Cool. I'm going to push you on a couple of assets which you raised yourself. So let's start with Dulles Greenway. You laid out some things there, but I guess can we get a arguably speculative picture on what a good outcome would look like to you? Understanding that there's a process to go through and there's politics, but what would you hope to get?
I mean, very simply speaking, the cash unlocked,
Yeah.
and in the quickest manner possible. Now that likely won't be very quick because lockups go for a number of years. But if I think about what we're trying to do, we're trying to utilise underlying traffic growth, a proper toll reform process, but also ensure the application of the future regulatory regime is consistent with our expectations, all in order to address our covenants. It's as simple as that. So the levers we're pulling target the tolls directly. They target the historic change to the regulation which occurred in 2021 that we deem as unconstitutional, and they target some historical compensation. But the key thing is how the legislation and the regulation is applied on a go-forward basis.
Yeah.
As I said, this has not meant that the Commonwealth of Virginia has disengaged with us, and in fact, Virginia Department of Transport, State Corporation Commission and Loudoun County are all in the room helping us form our next rate case. So I guess we're throwing everything at this in order to get out of the covenant issues more quickly. It is worth saying that on an underlying basis, we grew more than 6% last year. So even without intervention, at a point we would come out of lockup. We're just trying to accelerate that. So I think historically you would have heard management talk about legislative change or a number of very specific items. Without being flippant at all, I don't mind which option works. It is about getting cash flow earlier than we otherwise would with underlying growth.
Clear. Let's talk Westgate Tunnel. Been a drama over a number of years, but light at the end of the tunnel. Talk us through what a successful opening looks like and what you're thinking about over the next 3 to 6 months.
Yeah, well, you would have heard us on the earnings call talk about the fact that it's on track for delivery at the end of the year, but it is a massive multi-billion-dollar project, and we are very careful in saying it's not done until it's done. So we're kind of working through this critical final phase with the builder and the government on this, and there's still plenty to do. It's sort of now predominantly in tunnel fit out around M&E and the systems. The project itself will be transformational for the city. So for those of you who know Melbourne, it's the single most significant addition to the transport network in decades. And when you think about it, it's a piece of infrastructure that's servicing the fastest growth part of the city in the west. It's providing relief to the most overburdened piece of infrastructure in the city, in the Westgate Bridge. And effectively what it will do is provide a whole new way that people can move about the city. So, people in Sydney probably have a better experience of that than most when you think about now the options that WestConnex affords people in this city compared to what you had to do prior to WestConnex. Well, there's a parallel in Melbourne with the delivery of the Westgate Tunnel. It'll give a direct connection into the north of the city for those coming west, which means it'll take pressure off the southern corridor. The tunnel itself will be like a pressure release valve on the bridge, so it will take overflow, direct port connections for all of the logistics traffic, and then taking, I think critically in terms of social outcomes, 9,000 trucks off local streets in that sort of Yarraville precinct. So totally transforms that part of the city for the people who are living in it. And we've got experience of that kind of thing here with North Connects and Pennant Hills Roads. So for those of you who know that, it's actually socially quite transforming this type of infrastructure. So there is a sort of positive kind of tailwind coming for our business through the opening of this infrastructure. We're very focused on getting there, and there's still a lot of work to do to get it to the finish line. But once that happens, I think we see an inflection point in our Melbourne business, which, as we all know, is probably sort of done it tougher than most in terms of post-COVID recoveries.
Yep. And everyone in the room, I think, should know, but just a reminder, when Westgate Tunnel opens, the revenue sources that'll come, not just the tunnel itself. But
yeah, it's a really good point, Peter. So we've obviously already reaped a lot of the benefit from the pricing adjustments we made on the CityLink concession and then the extension of the CityLink concession itself. So the sort of economics of the project were only ever partially dependent upon the toll revenue that we're going to get off the new link, which significantly de-risks the economics of the project itself. And then in terms of the volumes that you get on that, I mean, we haven't given people all-in traffic numbers, but I think the proxy to use if you're trying to find a sort of EBITDA range to think about would be, we've said it's going to be broadly neutral on the capitalised interest costs that are coming through in the current year. So I'll let you guys go and look up what they are. But
page 52 in the annual report, something like that.
Just call it 150, 160 million with it.
All right, good. Thank you. Let's step back. That was project specific. They often say transport is a good leading indicator for what's going on in the broader economy. So just pick your brains for a bit, just from a macro perspective. What are you seeing across networks in terms of traffic flow, customer behaviour that might give people a read on the economy?
Should I start
Yep.
overseas? We're seeing a really significant difference, asset by asset and economy by economy. So it'll be partly macro, but I'll call out where the differences are. Mm-hmm. So if we start in Europe, a lot of the heavy vehicle traffic on the APRR network is driven by French and Spanish trade to the rest of Europe. That has been reasonably flat in the last couple of years. So that the trade balances between those countries, and we've further had quite a lot of action from farmers and disrupting the networks. And so that has been driving a reasonably flat performance of heavy vehicles. However, we have got some growth through the light vehicle market, in particular around great snow seasons and a bunch of those broader things. So I would say, though, the trade balances there have stagnated a little bit, and we've seen a slowdown there.
And people feeling optimistic at the moment about a pickup in European economy. You're not seeing any of that yet?
I think they are optimistic about some stability in French politics for even a number of months, genuinely, and I'm not saying that flippantly. There is more positivity there. Yep. But yeah, it hasn't picked up yet. We have got a good start to the year, but it's not where we'd love to see it in the long term. Mm-hmm. If we go to the US, tale of two very different markets. So in Virginia, we get a lot of questions about Doge versus return to work, mass firings. Actually, the drivers of our traffic there are very corridor specific and are due to local free roads being absolutely congested and pushing traffic onto our roads. What we're seeing is the Dulles Toll Road, which connects to the Dulles Greenway, they're literally connected roads. Dulles Toll Road is negative, Dulles Greenway is 6% positive. So I think on a net basis, you've got some economic challenges there and some challenges around the Doge impacts in the very short term. But we're not getting impacted by those at this stage, given we're 40 k's outside of DC.
Relatively wealthy.
Correct,
area.
Very wealthy, and still a lot of movement around Loudoun County.
Yep.
Skyway are hugely driven by domestic US production. And so we will get a read on that in the coming months. There are two theses there. One is the tariffs will slow things down, but the second is they'll bring them onshore. And so we're unclear yet what the net outcome of that will be. As most investors in this room will know, the story around Skyway is more a toll story than a volume story. But heavy vehicles are a key driver of our business case there. They've continued to grow, but it will tell a story about domestic production in the coming 6 to 12 months. It's a bit early to say that yet.
Well, maybe if I stay in the US, in our Virginia network, it's been incredibly strong, and that's partly a byproduct of the investment that we've been making in that. So it sort of more proves the kind of business model around repeat investment into the networks, unlocks healthy growth at very attractive risk return parameters, and we've seen that in Virginia. So we did the Fredericksburg extension on the 95 with a little bit of an upgrade around the Opitz Boulevard, not huge capex, but had mid-teen top-line growth in our business there, fueled by 7% volume growth, 7% price growth. So that's the business model classically at work, and more specifically the express lane model, because of that price growth that you could get in addition, which we wouldn't get in other parts of our business. So we're doing very well there. We're getting asked a little bit, much like Hugh, about the impact of all of the political goings on there, and it's very difficult to tell. We certainly haven't seen anything settle at the moment. The two sort of offsetting factors are, on the one hand, government workers being sent back to the office, and on the other hand, fired at the same time. And so how that kind of works out in the wash, time will tell, but we haven't seen anything significant in our numbers as yet. When you come to the eastern seaboard of Australia, things are reasonably healthy. So there's obviously a little bit of nuance to the story. Victoria has taken longer, as I said a moment ago, around the COVID recovery. It's still an issue. We clearly got that wrong in terms of what we thought the recovery curve would look like. It has taken longer, and by longer I mean years longer than we thought it would, to get back to a kind of pre-COVID level. So we're still weathering that a little bit at the margins in terms of that commuter traffic, which is really the affected segment. It's about 15% of the volume on the Victorian network. But as I said, the future looks reasonably bright there with what I was describing is about to open up on the network with the completion of Westgate Tunnel. Sydney is really a tale of competing themes. You have all of the capacity that we've introduced onto the network here, which absent anything else should lead into a period of elevated growth, but we're not seeing that because of the offsetting construction impacts, particularly with Warringah Freeway, and then a little bit of our own work going on in that M7 corridor. But what that says is once that construction profile dissipates, you should see that move into quite a healthy growth phase. And so the underlying piece is pretty healthy there, and certainly what we're seeing on WestConnex is good. And then Brisbane really is holding up, notwithstanding the horrendous weather impacts that they've had, including most recently with a cyclone hitting them. But the numbers we presented at the half had a 100% increase in rainfall against the PCP. The growth was still above 2%, so you'd say that's a network that clearly has strong underlying fundamentals if it can deliver those kinds of numbers, and we're talking actively about how we invest further into that network to unlock that growth path that I've been describing. So our numbers suggest that things aren't that bad, but that's just one data point for everyone to wrestle with, I guess.
Cool. So we've been through a period of very elevated inflation, cost of living crisis, proving up, value for money is more important than ever. I promise not to mention property prices in Sydney, but everyone's looking for what can you provide to justify the prices that you're charging on your roads. I wonder if you give us one or two examples of things you're doing, whether it's on a road or a customer offering, that's looking to improve that relationship.
Yeah, maybe I'll start in Chicago, because one of our biggest concerns getting in and under the hood of the asset was the quality. And in particular, when you've got an asset that is being driven, the growth is being driven by toll increases. It's really important that you match the performance of the customer experience with the cost of the tolls. So we are going on a bit of a campaign there, and we announced about doubling of the capex for the next year to drive really improved outcomes. One thing that we've really got to obsess about is across the border, our main shareholder owns the next road, and it's in fantastic condition. You can't cross the border and come onto a pothole-filled road. And so we are really conscious of this. It's a little bit like what we heard with the water utilities in the UK, quality and performance and the customer experience actually really matters, and we're just obsessing about that in Chicago, and we're bringing in a new CEO to do that. Where I look to excellence and where it's just been phenomenal, and I'm really enjoying experiencing the stories, but also hearing about the CapEx we're rolling out in the APRR network when we talk about electric vehicles and actually providing, because it's a 2,500 kilometre network as opposed to a single road, providing extensive charging facilities now around the network as the penetration of electric vehicles increases rapidly. That's being really welcomed by our customer base. Move towards free flow tolling, while it's absolutely normal on the Transurban network in Australia, it's highly unusual in Europe. And so moving our customers onto that new system while helping them understand it but also appreciate it is a big part of the customer experience. So I think APRR is the sort of the beacon of performance in our network. I would say Chicago needs a lot of work, and we're equally focused on them.
Yeah, and maybe the sort of guide for how we think about this is that comment I made around perceived and actual values. So the starting point is really there's a huge amount of value being delivered by the existing business that isn't always understood, that we have to do a better job of communicating to customers on, and that increasingly means more sophisticated, more bespoke digital offerings, a better customer interface, and we're working very hard on that. So you would have seen in the investor materials we produced for the earnings call, we just called out, an example in the Sydney network here where the trip for people coming from Parramatta to the airport is effectively now 40 minutes quicker for people using our infrastructure than it was in 2018. I mean, it's life-changing, that kind of value, when you think about people who might be doing that on a daily basis. And then that's before you get to fuel and you get to vehicle wear and tear and things like that. So there is a huge amount of latent value that we could do a better job of communicating on, and it needs to be done in an increasingly sophisticated way and in a way that people will engage, because we have effectively more than 10 million customers that we're trying to engage with through these digital platforms. So we're thinking a lot about that. And then it gets to how we're augmenting the value of the business beyond what we do to build more infrastructure, because increasingly it has to be more than just building the infrastructure in of itself that wins us the right to continue to do this sort of thing as a business. So we're thinking about the kind of overlays we can bring as a business in terms of technology. One of the examples that people have seen us talk about is the recent kind of interest in New Zealand, which caught a few people by surprise, but the strategic kind of impetus sitting behind that was partially the fact that it presents a really interesting market that could be a test bed to develop some new technology products around things like road user charging that then we can deploy at scale into other markets, which is a value-added offering onto the infrastructure that should be appealing certainly to government clients, potentially to customers as well, depending on how we configure it. So that's the kind of work we're doing in the background just to augment that. And then we've got much more sort of customer-driven things like the rewards program I described. So, we've seen the number of customers in our rewards program increase from 250,000 to well over 1 million inside the last 12 months. They're still not huge numbers, but they're big enough and they're moving quickly enough on what is currently a very basic proposition to say there is a real value piece here, where if we can find a way to build a rewards ecosystem that presents customers with even a sort of small amount of value. Most customers are spending less than $10 a week on tolls. You could offset almost all of their toll bill if you came up with an effective ecosystem where they could actually articulate that kind of offsetting value in another way. So we're thinking about that as another pathway that might potentially be quite valuable for us.
You mentioned New Zealand there. The other surprise that came through in your last result around the relationship with Sintra forming in the US. You just want to articulate what opportunities you're seeing in the US market and why team up with Sintra that historically has been a competitor, and the relationship's been a bit strained, I could say. What opportunity do you see there now?
Yeah, they've been a fierce competitor, and we've flipped the script on that a little bit with them. So that's obviously been something that we've both taken a first step on, and I would just describe it as that. It's a first step to test whether the partnership makes sense. But there was a couple of things going on. The first is we're looking at new market entry strategies and thinking about how we can mitigate risk on that. and so that's mitigate balance sheet risk. It's also finding ways to potentially create deployment of capital pathways for us over time. So we're starting small, skinny on equity in the partnership with them, but we're saying that if it's successful, we would be willing to deploy further capital in this and upweight our exposure. So there's a piece around management of risk. That also extends a little bit into the complementarities of the business themselves. So they're vertically integrated, we aren't. So we quite like the exposure to that, where they bring that vertical integration as we're thinking about how competitive we are in bidding into new projects. They probably like some of the things we bring around longer term holders, working with governments to deploy capital into networks. So you say, well, there are clearly complementary aspects to our business, and then there are overlaps that we actually quite like too, around things like traffic modelling, particularly as we think about greenfield risk. So you sort of add all that up, and we're managing risk on the one hand, and we're making ourselves more competitive if we get this right on the other. Strategically, I think that's a pretty clear basis to move forward on.
Yeah, given the last deal there, we hope you stay disciplined in that relationship, which I'm sure you will.
I'm sure we will.
Hugh, I'll just expand on that with a final question. Is I guess you've inherited a situation, if I can say that, where the last deal, there's a general perception that you overpaid for a strategic asset with a long life, but that's yesterday. From here, what do you see as your mandate, from your shareholders, from your board, in terms of expanding the business beyond the existing assets?
Thanks, Peter. Look, the mandate is very much to fix the key issues.
Yep.
So it's not to go out and focus on M&A at this point in time. So it's really clearly, we have a lot of inherent untapped value in both DG and in APRR, and we need to embed Skyway into our business and prove that value up to our investors. So that is the task right now, and that's a very significant task. And those, particularly with the concession expiry and with the litigation going on in DG, that's a lot to work on and a lot of value to capture. My hope is that once we start to resolve those issues, we will become a growth entity again. That's why we're not sitting on our laurels, resting on our laurels in terms of partnerships. I don't believe we have the license to go and grow on our own, even when we're ready. I don't think we're going to be competitive in every market on our own. Unlike Transurban, we're not looking at greenfield. We're looking at brownfield. And we need local partners, people that value the expertise we bring to the table, allow governance. And so we are spending time investing in our existing partnerships and new partnerships as we try and set ourselves up for that future success. But very clearly, we don't have a mandate to raise capital and invest. We need to resolve those issues and drive the value to our investors, to our end investors, that we promised with the investments in these businesses.
Well said. Two great businesses, really well run. Thanks for your time, please. Thank you, and Henry.